The first time I used grid trading was in 2019, and in less than 2 years I had grown my portfolio from around 30k to above 100k mainly by using this strategy. Today I will show you exactly what I did and the advantages and disadvantages of grid trading and why this is maybe the best way to trade crypto, especially as the markets are evolving. Hello everyone, welcome back to Crypto Grid channel. My name is Željko and today I am excited to share my thoughts on grid trading. But firstly, above 80% of you who are watching this video are not subscribed, so if you see value in this video that I'm creating, please consider subscribing and liking this video. Thank you. So why are we discussing grid trading at first? Along the way in my crypto journey I've tried many things to make profits in crypto markets. From taking signals from different groups at first, learning technical analysis and swing trading, high frequency trading, staking different assets, looking for small alts, DCAing, well, the majority of the things that you could actually do in crypto markets. Usually, I either ended up with a large drawdown on funds that I devoted for that, or it was like earning some money, then losing some money again. I wasn't able to find anything that would work in a long run, and I was always more focused on finding something that would give me small but consistent and compounding returns over time, and something that could be predictable in terms of returns over a longer time frame. That's how I came across grid trading. Since I'm a data-driven person in general, I did a lot of backtesting on the volatility of different assets, finding the balance of grid density in comparison to position sizes and exchange fees, pretty much all the factors that would affect the potential returns and drawdowns of different modifications of this strategy. I'll go more in depth on these factors later in this video, but let me first explain what is the grid trading. When we are discussing grid trading, usually that means that we are placing a multiple incremental buy orders below the current price and multiple incremental sell orders above the current price. There are usually two ways how people actually use grid trading. So the first one, which personally I don't use, is people are trying to identify part of the markets when we are in arranging markets, and they usually set the orders in a way that they're trading in a certain range, and they usually place stop losses if the price goes out in a range up for short orders or out in a range down for a long orders. So pretty much if you are starting here and this is the current price, you would buy here, you would buy here, you would buy here, then you would start selling again as the price starts going up, and these are the moments when you would start taking profits. There are multiple ways how you can execute this. Many people even, like for example when we are in this area, they are buying all the way here, but when the price goes out of the range, they usually try to place tight stop losses. So they pretty much exit their positions trying to minimize losses somewhere in this area. Or if they're taking profits, they don't take profits for each separate orders. Instead, they look at the average buying value for multiple buys and then they try to sell it just above the middle of the range. The reason why I'm not a fan of this strategy is because we will have often a lot of breakouts and breakdowns before we are able to catch the ranging market. So this means that we will have a lot of stop loss orders actually hit before we are able to make some profits. The way how I like to use this strategy is I pretty much split the whole market into a grid. In this example, it's pretty much on every $1,000 I created a grid. I'm not sure exactly how many grids are there, but pretty much the system is as I said. For example, let's say if we are in this area, my labels moved slightly when I made the charts, but it doesn't matter. So for example, if this is the current price, once we drop here, we will buy. Once we drop here, we will buy again, buy again, buy again, buy again. Then once the price goes back up, this is the moment when we will sell here and we will sell here on this week. So once the price retraces back, then this is the moment when we will buy again, sell again, buy again, then sell, 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 sell. So pretty much you understand how this works. Obviously the profits that we are making will be mainly based on the amount of trades, position size, and moving percentage from one grid to another. Also, this second method can only be used in a spot market, so pretty much you're making profits when you're selling and you're accumulating more assets when you're buying. The first method, it can be used on both futures and spot market. As I said, I don't like to use the first method, and both of them are best used in a ranging market. So if you have ranging markets, you will have much better performance, especially ranging markets with higher volatility. So if you're looking at what factors will affect returns, obviously asset that you're trading is one big factor because different assets have different volatilities. During the past, there was a moment when I pretty much calculated volatility of different assets. So as you can see, Bitcoin is usually the one with the lowest volatility, and usually the assets which have the larger market cap, they have lower volatility in comparison to the smaller ones. Another thing that is interesting to look is Bitcoin volatility index. As we can see, we are pretty much in a low ranges in comparison to the areas where we previously been. And to make good profits with this strategy, you actually need higher volatility. The risk of this strategy which goes with high volatility is that you don't want to trade an asset which can potentially go to zero, because you will just have that asset highly accumulated without being able to sell it at higher prices. And that's probably the biggest risk of grid trading in this way. Also, since you're spreading your assets across all the ranges, usually you want to have money available or assets available to use at any of these ranges wherever the price goes. So this obviously shows that this won't be interesting for somebody that have portfolio of $1,000 or something like that. The bigger portfolio, the better it is, to be honest. I wouldn't start doing this with portfolio that is smaller than 10K, let's say. Another thing, in a perfect scenario, obviously you would want to buy here, sell here, buy here, sell here, buy here, sell here, and so on. And because that's not possible to predict the markets that accurately, this is the reason why we are even using grid trading, because all the time you are taking small amount of profits. So one of the most important factors when you're creating this strategy is to actually have sufficient amount of grids, but not too much, because if you are using too many grids, if we get to a trending markets, for example, as we had here, pretty much you would be selling your assets too early. And also, the more buy and sell orders that you have, the fees will accumulate over time. The reason why you don't want to use too few grids is because often it can happen that, for example, imagine that we have less grids and you have this grid and then you don't have the next few ones, that you miss to buy at the best possible price ranges. And same applies for selling. Imagine if we had the grid here, but you don't have this one, so you're missing the best possible scenarios where you can actually make the most profits. Another important thing to address is you always want to define what is the bottom of your grid and what is the top of your grid. Because if this grid is too narrow, for example, let's assume that the bottom that you assumed for this bull run is, let's say, 20K, you would miss buying completely for anything below 20K. And as I said, for the best prices where you can actually buy, you would miss that opportunity. Also imagine for the previous bull run, if you place the top range of a grid at 50K, for example, pretty much means that you would sell all your assets before we actually reach the top and where you can actually make the most profits. From the other standpoint, you don't want to make too many grids. If you placed the range from like 0 to, let's say, 200K, this means that each of these positions would be much smaller. So the better that you can hit the range, the better it is, but still you don't want to go too wide, because if you're going too wide, then you will have some amount of money and assets completely unutilized in this strategy during the whole cycle. Again, in my opinion, it is better to have slightly wider range than too narrow range, because if you would sell all the assets at 50K range, then pretty much you wouldn't be able to sell at this area. then again you wouldn't be able to buy when we retrace as well. So this is a big obstacle. Another issue that you would need to deal is that you would either need to redefine the range where you sold majority of the assets before the time when you should actually do it. Another thing that you need to take into consideration is, for example, since this is done in a linear fashion, when the price moves from like 15K to 16K, you earned $6.66, for example, if the position size is 100. While if you move from 30 to 31K, for example, as we did here, you would earn half of that, so $3.33. So more frequent trades in a lower ranges actually benefits you more. So as I said, this is a linear scale, but for example, imagine if you would do it at a logarithmic scale, you can see that these ranges here seem smaller. Imagine if we use same spacing between the grids. That would mean that each time that you're taking profits, you're taking 1% profit here, you're taking 1% profit here. With linear that I'm showing you currently and which is presented currently, to calculate profits, you pretty much divide position size by buying price and multiply it by selling price, and you would have $106.6, and pretty much you deduct your position size, and that's how you calculate returns for each of these orders executed. And as you can see, even with this strategy, without thinking a lot, you would have a lot of buy and sell orders where you would actually take some of the profits. A lot of you who are watching this video heard from Benjamin Cohen and is watching his videos as well. One of the things, I'm not sure if he's still doing that, but one of the things that he was doing before when it comes to investing, he has like highly strategic videos when it comes to different analyses and things like that. But when it comes to the investing, he uses a pretty simple approach. He pretty much calculates how much undervalued or overvalued Bitcoin is in comparison to the current price. And pretty much he positioned that like, if this is real value, if we get to this level of undervaluation, he divides his portfolio in 15 pieces and he invests like 1, 2, 3, 4, 5. And pretty much when he's selling it in a similar fashion. So 1, 2, 3, 4, 5 based on how much the asset is overvalued. So pretty much if you count 5 from 15, that would be like 33.3% of his portfolio. And each band is smaller position size. So the risk with this is, as I mentioned, if the price doesn't retrace to the lowest bands, he will have 33.3% of his funds completely unutilized. So if the price actually goes into this area and goes into the top band, he will make a huge profits in this way. So all of these approaches has its benefits and its drawdowns. Another factor to think of is if you look into the charts and we have, for example, one buy done here, one sell made here. The profits that we are taking, we can actually take them in USDT or we can take it in underlying asset as BTC in this case. And usually, if we are in uptrend, it's better maybe to accumulate BTC since you can keep it and sell it at like high ranges. If you are in a downtrend, maybe it's better to keep it in USDT because if we, for example, miss the grid and we didn't place it low enough, we can use that USDT to buy back more at the lower prices. Also, since by each trade your portfolio is growing, you can compound by equal distribution, which means that you spread assets across the whole grid and across all ranges, or you can keep larger trading positions at the ranges where we spend most time so you get the higher returns at that area, for example. Obviously, with this strategy, there is a lot of things that you can actually play with. When it comes to the risk and opportunities with these strategies, as I said, the largest risk of this strategy, since you're DCAing both up and down, is that the asset value goes to zero. The best way to prevent that is to set either a stop loss once you get to some drawdown and to actually cash out profits from time to time. The more that the asset is oscillating in some range, the better it is for you, since you're taking profits along the way. Second largest risk is if you are not great at determining the potential area where the price will be, because if you determine that the previous peak would be at 50k, you have the area from 50 to 69k where you can't sell your assets because you already sold everything. So you're missing large gains in that area. When it comes to the retracement, if you expected that the Bitcoin would retrace to 10k, you would have a lot of money in a range from 10k to 15k that is completely unutilized and that is not serving the purpose. Another issue, as I said, is if you have a strong trending market, because if you're buying, you don't want to buy along the way. It's much better if the market stabilizes and then you buy an asset. Same happens when it comes to selling. You don't want to sell it all the way up. You want an uptrend to finish and then sell all the assets that you're accumulating. So for example, in this area, it's much better if you wouldn't buy here. If you waited the price to retrace and buy all the assets in this area, your average buying price would be much better. Same applies when we started going up. It would be much better if you haven't sold here. If you waited this area where the price started consolidating and you sell majority of the assets that you bought in this range, at this range, you would have much better performance of your portfolio. When I started using this strategy, there were some days where I had over 200 trades playing out daily. Now at low volatility, depending on how you use this strategy, you can end up in a situation that you don't have a single trade for days. Still, you saw what happened a few days ago when we had, for example, this strong week, we had this week. These are the perfect moments when you can utilize this strategy, when majority of the people are actually complaining how they lost money if they shorted the markets at this area or something like that, or if they long here. All these swings and volatility increases actually creates profits for you with this. So this is the reason why I actually like this strategy, because it doesn't matter in which direction market is going as long as it returns to the previous value. And once that happens, you're able to re-enter the trade with a larger position size again, which means that the profit will be larger the next time as well. The issue with this is if you don't have orders set up, you will most likely miss the moves because they often happen so fast that it's impossible to execute them. So you will most likely need to have some of the money on centralized exchanges that are already set up in a limit buy and limit sell orders. Also, as the markets are evolving, and if you look at the previous bull market, majority of people either missed first or second move. If you use this, you would be taking profits all the way. Same if we go to 40k, for example, now, or if we get triple top at 69k and then the price retraces, I feel that this is an awesome tool to use. Also, as the markets are evolving, and if you look at the previous bull market, majority of the people either missed up the first or the second move. If you use this, you would be taking profits all the way because you would be buying at this area and selling at this area again. Same for the first time, you would be buying all the way here and then you would be selling at this range. Same now, if you would go to the area of 40k, or even if you would create triple top at 69k or something like that, you would be able to profit all the way up. If you have prolonged bear market or something similar, you would still accumulate more assets in that range and then you would be able to sell them higher. And remember what I said, the more that we spend time in the lower ranges, the more profits and the better position you will be for the next bull market. One of the issues is, as I said, is if we have some high volatility move that happened on US exchanges, for example. Let me find it. So as you can see, this is Binance US and this is BTC USDT pair. And on 21st June, we actually had a spike of BTC to like 130k, which pretty much eliminated all the shorts. And with this strategy, this would be great for you because you would have all your sell orders executed and you would be able to buy back at lower prices. But the risk with this is you would need to hold all your money on centralized exchanges to have all these orders set up. And you don't want to do that because this is exactly how I got hacked on Binance and how I lost majority of my money. So this is a big risk when it comes to that. So whichever strategy you're using, make sure to pivot your strategies that you can execute them outside of centralized exchanges. So this is something that you should definitely utilize, but you shouldn't be like fully relying on holding all of your money on one exchange and like being exposed to these situations. Also, since you're executing a lot of trades, often you would want something like this to be automated or managed by some bot on centralized exchanges, which again exposes you to more external risks because you probably heard how many of these bots were actually hacked previously. Another thing that is important to take into consideration is time frame that you're using, because it will affect everything. Because if you have a strong up down move, which often happens when you have some news like CPI or inflation rate data, you can potentially miss some of the opportunities. Of course, if you're using some bot, as I mentioned, you won't have these issues, but in general, these moves would require your presence on the market. As I mentioned, this is maybe not the right thing to do with a small portfolio, but if you're persistent, you'll see results and returns compounding over time. The good thing is that this system pretty much increases market liquidity, and you can utilize it even with the low liquidity assets, since your positions aren't that big if you look at each of them separately. The last thing that you need to be careful with are fees. If you create too many grids, your position sizes will be smaller, and the movements from the point when you're buying to the point when you're selling will be smaller as well, which increases fees in comparison to returns, or you can sometimes even outweigh the returns. So make sure to calculate it once you create a grid. So if you do something like this with Bitcoin, you will have like 1 to 4% returns. If you do it with Ethereum, it will be like 3 to 6% returns. If you opt for some riskier, smaller cap coins, you can get even up to 10% returns monthly, which is great in today's markets, especially if you compare it with the paid groups that are trading all the time. Returns highly depend on the factors that I mentioned, so make sure to explore and test different things. I feel that this is one of the most underused, but yet one of the most simple strategies as well. Still, it would be really good to use this in confluence with other indicators to minimize the risk about which I talked and maximize potential returns. As I said, I used this for a long time and I was satisfied with the returns. I'm working on improving the original strategy and parameters that I use, and once that's finished, I expect to have consistent 5% plus returns monthly, hopefully up to even 10% when higher volatility comes. With minimized risk and exposure of losing assets, which is the goal, since once you experience what I did with Binance, you don't want to put yourself in a similar situation ever again. Anyway, please consider subscribing. If you have any questions or something is not clear enough, I answer to all of them, so feel free to post them below. Thank you for watching, stay strong and healthy, bye!